So again, here in D, claim opinion says the auditor provides reasonable assurance there are no material departures from GAAP or material scope limitations. Well, as we said, thus there will be and can be immaterial departures or limitations for virtually every client. In fact, even material departures from GAAP, material scope limitations also may remain undetected because the auditor applies reasonable assurance in his or her work. So we don't give absolute assurance, so something can still be wrong, even though we give a reasonable assurance. That includes gathering evidence on a test basis, so we may not have sampled the one piece of evidence that had material error in it. As we'll see during the course, if this happens, the auditor is going to rely on documentation in his or her audit documentation, commonly referred to as working papers, to show that he or she applied due care and followed proper auditing procedures. So, we're not perfect, but again, even the most careful audit may not find everything. So we may have issued a claim opinion when, if we've been able to see all the evidence, there was a major problem out there. We shouldn't have given a clean opinion. So there's always the possibility that we're wrong, even though we did all the work we should. So mantra is, if you do that, document, document, document. In fact, and how many professions today do you think that the mantra is document, document, document? A whole lot. Just like next door, as RADA, the general contractor, is building the Weinstein Computer Science Center. You bet that RADA is documenting everything, right down to all the subcontractors, making sure that they comply with OSHA regulations, for example, because if they don't, and there's a question even years later, that can come back to bite them. In this case, somebody would allege that they violated some federal compliance requirements. You don't want that. RADA could get into a lot of trouble. And if you don't have the documentation, that automatically says you lost the case.
So, Professor Quillam, are you saying that the CPA firms keep copies of all the work paper, like the sample sources that they request to test?
They do. And under the Sarbanes-Oxley Act, there's actually a discrepancy. One place says 5 years retention. Another place says 7 years retention. So practically retained for at least 7 years.
Okay.
Good question, Karen. I see what you mean. Anything else so far? All righty. So let's make a little bit more formal definition of what's material. Well, an item is material if it can change a financial state or arrears decisions. And that sure is a big judgment call. But materiality is usually decided by comparing an amount against some benchmark, some base, very notably against an income figure. And if something is not measurable in monetary terms, such as fulfilling scope limitations, then the judgment's even more of a judgment call. We don't know how many dollars might be involved in a scope limitation because we could not examine the evidence we wanted. Well, I have a little note there. Let's remember conservatism. So let's say we're not sure if an item is material or not. Which way should we lean? Lean toward the conservative side, in which case we will declare that item to be what? Material, you bet. Well, then number 2, some items are material due to their nature, regardless of the dollar amount involved. I'm going to show you a list on page 62 in just a moment. And we also need to add most related party transactions to this list. Well, related party transactions, such as major stockholders, senior management, directors, or related companies, they're not arm's length. They therefore pose a high risk. In fact, nearly every accounting fraud has involved related party transactions. A common type of related party transactions is where a so-called loan has been given to a major officer of the company, and it's outside normal free market terms. There's no fixed day of repayment. There may be no interest. So really what it is just extra compensation and tax-free compensation at that. That's been a very common type of related party transaction. The related party transaction, you do not have two adversarial parties, independent parties, at arm's length with each other to reflect normal fair market value terms. So we always must be very careful of related party transactions and check most of them out. So even if they're fairly small, they're material. Let me turn page 62 in the book, and I think that these things will make sense too. Just find where that is here in the online version of the book. Again, they move things around a little bit here. First, the printed copy. There we go, nature of the ion. So if something's material, like I mentioned, we're usually comparing an amount against some base, like income. So if we had a small, privately held mom and pop company where net income has been misstated by $10,000, but mom and pop only have a total of $100,000 of net income in their company, would you say this $10,000 misstatement is material? Yes. On the other hand, if we have a large corporation with millions of dollars of net income, would you say that a $10,000 misstatement in income is material? No. So you can see how materiality there is relative instead of absolute. We're comparing against some base, some benchmark, very commonly to net income. So let's see the nature of the ion. Well, these things might not be material due to their dollar size, because it can be fairly small in dollar size. But just because of the nature of what's going on, we might have a problem. So we see here in the book that the decision of a user may also be affected by the kind of misstatement. And the following may affect a user's decision and therefore the auditor's opinion in a different way than most misstatements. So auditors usually declare these to be material. That means the auditor investigates them and will require anything to be cleaned up before giving a clean opinion. So first of all, transactions are illegal or fraudulent. Even if small, how comfortable would you feel about those? You wouldn't. No, that's why the auditor wants them hopefully cleaned up. They often require footnote disclosure too. And you think companies are very fond of disclosing these? No, they're embarrassing. Companies like to cover them up. That's why, for example, in frauds, most people that have stolen from the company or committed some other type of fraud, are they prosecuted? No, they're not. They're not prosecuted because it's bad PR for the company. Just like about 3 or 4 years ago now, Southeastern University had a fraud in which the director of development, the fundraising person, was accused of taking, it was over $200,000. And he may well have done so. But Southeastern University just kind of quietly let him resign and fade into obscurity. Now, he wasn't prosecuted. And Southeastern really didn't want to conduct too much investigation. Just kind of like, let's let him go and we'll go on with our lives okay. That happens a lot in organizations, I'm afraid. But ethically, how do you feel about that when it comes to a religiously affiliated organization, is that very consonant with the mission of a religiously affiliated organization? And no, it's not. It's not. No. And you know, that did have an effect on Southeastern's fundraising. You have to be really careful as a not-for-profit, and I know very well from here in Florida Southern, because you can easily turn donors off. Yeah, it's kind of like, why would I give to that organization when they're just going to take my donor dollars and let them be defrauded? Not good. We're really careful here. Excuse me. And definitely, if our donors knew that we were doing something that is not very constant with the Methodist affiliation, that wouldn't go over well either. By the way, most of the big donors here are either Methodist or Jewish. And so, yeah, there's a religious connection there. And they want to see that their donor dollars are safeguarded in a very ethical manner. Yes, very ethical. And that really happens in any not-for-profit as well. Well then, an item in number 2, an item may materially affect some future period, even though it's immaterial when only the current period is considered. For example, there's an error in Excel cell formula. It caused a really small error this year, dollar-wise. But if this cell formula error is allowed to go on, this little bit of misstatement this year is going to grow bigger and bigger and bigger in the future. Here's what the auditor should do. The auditor should collapse materiality back to the current period. The auditor should declare this to be material. That means fix this cell formula error before it snowballs out of control. Yes. Nip it in the bud. And number 3, an item has a psychological effect. For example, the item changes a small loss to a small profit, or maintains a trend of increasing earnings, or allows earnings to exceed analyst expectations. Ooh, because those overriding things, let's declare that small misstatement to be material. Let's correct it. Small dollar-wise, but not small in terms of effects. And number 4, an item may be important in terms of possible consequences arising from contractual obligations. For example, the effective failure to comply with a debt restriction may result in a material loan being called. So let's say that as a debt restriction, usually called a debt covenant, by the way, that the bank requires that we have a minimum of $10,000 on deposit at all times with that bank for the bank to give us a loan. That way the bank has some collateral and gets some additional business. If our balance drops just below $10,000, the bank may be very mean, especially because interest rates are very low compared to past decades. So the bank may increase the interest rate, credit cards do too, or the bank may just say, we're going to call that loan. That means that the client must repay it right away. So even a little bit of an error, dropping that account balance below $10,000, we violated the debt covenant. So conversely, if that balance is just above $10,000, we start to get worried as an auditor. The client may technically violate it by allowing it even to drop $1 below, and if the bank's mean, there we go. So auditors always start to worry whenever debt covenants are getting tight, or any other contractual obligations getting tight for that matter, because just a little bit of a misstatement could place client in violation. Any questions so far? All those things make sense? All right. Well, then in number 3, materialities does not apply for lack of independence. For example, an auditor can own even one share of stock in a client. If you do, you're not independent. You cannot be on the board of directors. Same thing applies to immediate family members or anyone living in your household. So, we might say owning one share of stock out of millions outstanding is immaterial. Well, no. Even though it's only one share of stock, we consider it to be materialist in a ledger. There's more information about that in the EICPA Code Professional Conduct in Chapter 4, which I just have you read, for background information. I will test you on it as such. So either you are independent or you are not. It is one way or the other, a binomial distribution, and no in-betweens. And then in number 4, an IA may be immaterial. So that's something really low. We're not going to sweat it at all. It may be on the other extreme at the high, pervasively or highly material. We really sweat that one. We say stop press, we find it. So highly material, so material that it's going to pervade all the financial statements. They all tie together because of double entry accounting. So the entire set of financial statements is messed up. That's really bad. Those things don't happen very often, but just in case. Well, or something could be in the middle, somewhere between. If we find something that is above immaterial, it's usually somewhere in between. And yeah, we'll sweat those too. So this will affect the type of audit opinion to issue. And we can see that on page 66. I will with you in a second. And again, remember that a clean opinion can always be issued for immaterial departures from GAAP or immaterial scope limitations. Let me just put an S there. Whoops. Well, however, the audit report must be modified. Materiality is pervasive or somewhere in between. So for the rest tonight, we'll cover these situations. And let me show you. Table, good, there it comes. Oh, that's actually not it. Oh, they moved it. Okay. Again here in the online version, usually about a page off. Let's see if it comes up here on page 65. Things moving slowly today. There we go. Okay. Online, it's moved over to page 61. Wow. So again, sometimes we have to search for things a little bit because the printed page does not conform to the online page. That's okay. Now, by the way, last week when I could not access this book, I couldn't access any books online from Pearson. Somehow I'd been cut off altogether. So I had to get customer service to go in and unfreeze my account. I don't know if someone's trying to hack it or just what. Granted, I don't pay for the account, but well, it was probably something like that, or maybe just a technical issue. But would happen on the first day of class. All right. So, relationship materiality, a type of opinion. Well, again, if materiality is immaterial, most things are. Users' decisions are unlikely to be affected, so we give an unmodified or a clean audit report. But then, this in-between level of materiality, if something gets bigger, it bumps up into that. So users' decisions are likely to be affected only if the information in question is important to the specific decisions being made. The effect of the misstatement is not pervasive to the financial statements, and the overall financial statements are presented fairly. So it's kind of an isolated thing, if you will. Type of opinion we will give is called qualified. Sometimes people think that sounds like a good thing, but it's not in auditing. English is an odd language because one word can have two entirely different meanings. So qualified can be a good thing, like somebody who is qualified for a job or a company who's qualified to be in business. Or in this case, a qualification could be a negative thing, a reservation. Like I cannot give my unqualified support for something, I have to qualify my support. So it means just the opposite as well. Which is something I really discovered while teaching in China. And well, if students run into a term like that, it is very confusing for them. So I had to make sure they understood that in English, one term can have two very different meanings or more. Conversely, two or more words may mean the exact same thing. And we see that all the time in the way of terminology, just like audit report, audit opinion, et cetera, et cetera. So if an item's material will change the audit report by qualifying it. Now, if we bump up into this worst case scenario, highly or pervasively material, so most or all of a user's decisions based on the financial statements are likely to be significantly affected. The effect of the misstatements is pervasive to the financial statements. It just flows all the way through them and makes them all not to be relied on. Type opinion. Well, we'll see for a scope limitation, we will issue something called disclaimer. We can't give an audit opinion. We disclaim one. It's bad. Or in the case of a departure from GAAP, like a misstatement, we will give an adverse opinion. That's really bad too. We say these financial statements do not conform to GAAP at all. So again, that's the worst case scenario there. And we'll see a little note here, lack of independence requires a disclaimer regardless of materiality. We'll see it too. So what are we going to see here? So in Roman numeral 2, departures from the standard unqualified audit report when something is materially wrong. And again, that could be a departure from GAAP, could be a scope limitation, could be a lack of independence. So first of all, in A, we always give the client a chance to correct before we modify our audit report. And if the client corrects everything, then the financial statements are fairly stated and no material departure from GAAP or material scope limitation exists of which the auditor is aware. We can then issue a clean opinion. That's why almost all audit reports are unqualified. They are clean because clients are very motivated to fix what's wrong. They may not like doing so, but they sure don't want anything less than a clean opinion. That's why I say the auditor basically has a big cleanup act on their hands, oftentimes. And then B, except for lack of independence. Special case, we'll get into it at the end of this section. Each of these departures will require the addition of the basis for the qualified opinion or disclaimer of opinion or adverse opinion, I will show you, which precedes the opinion paragraph, since the opinion is modified. So this way, we read through the audit report, we will have this explanatory paragraph of what's wrong, and I will show you again, before we get down to the opinion paragraph. Then that opinion paragraph is not clean. The reader already knows why. So that placement above the opinion section is very important. They test all the time on the CPA exam, including in that type of simulation question I mentioned, where they give you various paragraphs and you have to drag and drop them in proper order. So each of these reports is based on the standard unqualified audit report, so we'll just concentrate on what is modified. So let me tell you about scope limitation first, here in C. So a scope limitation may result either from conditions, such as when source documents have been destroyed in a fire, or from the client, such as when management refuses to allow the auditor to examine some needed evidence. Ooh, well, how'd you feel about that second one? Not good, because if management will not allow us to examine some evidence, sounds like they have something to hide. Yes, it's bad. So I have a little note there. The former is the most common scope limitation. Client cannot correct it. So from conditions, the client may have been careless or used poor judgment, but the client cannot help it in the end. And there's no malicious intent going on. In fact, for that second one, management refuses to allow us some evidence. Ooh, a lot of auditors are actually going to withdraw from the engagement at that point. And we can always do so. There's always that out. Well, scope limitation will cause the auditor to issue either a disclaimer of opinion. I'll show you one, if it's highly or pervasively material, or a qualified report if it's somewhere in between in terms of materiality. And it's often hard to decide upon materiality for scope limitations than for departures from GAAP. That's because we do not necessarily know how many dollars are involved with that scope limitation, since we could not conduct all the audit procedures we felt we needed. So we may not know how many dollars are involved because we just couldn't see everything. So it may be very fuzzy. Well, thus we may play it safer and more quickly decide the situation as highly material with scope limitation. And we will also note that we will be especially quick to decide that a client imposed scope limitation as highly material. In fact, as I said, the auditor may even withdraw at this point, especially if he or she appealed to higher levels of management and did not obtain a satisfactory resolution. We'll see examples of reports for scope limitations on page 64. So 3 little notes. First of all, in both reports, the section of the basis for the qualified or disclaimer of opinion precedes the opinion section, explanatory paragraph. And then number 4, in the qualified report, the last paragraph, the auditor's responsibility section is changed to reference qualified opinion. I will show you. The opinion is unqualified with the phrase except. The rest the same as in the standard unqualified audit report. So let me show you that here in the book. It's in 3.8. So 3.8, figure 3.8, refers to that. We see the independent auditor's report. Everything is the same up front. Same introductory paragraph, management's responsibility paragraph, and first 2 auditors' responsibility paragraphs as a standard report. Well then, this next, a little paragraph ending it up, is changed. We believe that the audit evidence we have obtained is sufficient and appropriate to provide a basis for our qualified audit report. We just insert the term qualified. Then this explanatory paragraph or basis for qualified opinion is appearing before the opinion paragraph. So let's see what it says. Here's what's wrong. Lawful Incorporation's investment in XYZ Company, a foreign affiliate acquired during the year and accounted for under the equity method, you'll learn that in advanced financial accounting, is carried at 2.4 million. The balance sheet as of December 31st, and Laughlin's share of XYZ Company's net income of 365,000 is included in Laughlin Corporation's net income for the year that ended. We were unable to obtain sufficient appropriate audit evidence about the carrying amount of Laughlin Corporation's investment in XYZ Company as of December 31st, and Laughlin's share of XYZ Company's net income for the year that ended, because we were denied access to the financial information, management, and auditors of XYZ Company. Consequently, we were unable to determine whether any adjustments to these amounts were necessary. This is a nice auditor. This auditor said, okay, even though it's management imposed, we'll go with the in-between materiality situation and just give them a qualified opinion. So sure enough, they did here. In our opinion, except for the effects that are described in the basis for qualified opinion paragraph, financial statements referred to above present fairly and the remainder is the same. So except for this one thing, everything else is okay. Any questions on that? All right, back here to the notes. Looking at number 3, in the disclaimer opinion for the highly material scope limitation, the section of the auditor's responsibility is changed in wording and shortened by omitting the last 2 paragraphs as an effective audit cannot be conducted. The introductory paragraphs modified to say we were engaged to audit instead of we audited. Again, we couldn't do a regular audit. The opinion section is actually a disclaimer of opinion. All right, let's see that here. It's in figure 3.9. So in this case, this auditor said that situation's really bad, highly material. So it starts off, we were engaged to audit. Remainder the same, it's in the standard report. So we couldn't do a regular audit, we were just engaged to audit. Then same management's responsibility paragraph as a standard unqualified audit report. And then the auditor's responsibility is really shortened. So our responsibility is to express an opinion on these financial statements based on conducting the audit in accordance with auditing standards generally accepted in the United States of America. Because the matter described at the basis for disclaimer of opinion paragraph, however, we were not able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. It's bad. Then this basis for disclaimer of opinion or explanatory paragraph, the same wording that we just had above, same things going on, but this particular auditor in figure 3.9 is very conservative, has said that this makes this bad scope limitation really, really material. So then this auditor gives a disclaimer of opinion. Because of the significance that are described in the basis for disclaimer of opinion paragraph, we have not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on these financial statements. So that is really bad. What do you think the SEC would feel about this? They won't, and they're not warm and friendly people. They'll say, you cannot trade your stock anymore. Not until you give us something better than this. It's really bad. Any questions on it? All right. Let's take a look next into departure from GAAP. It's going to cause the auditor to issue either an adverse opinion, if it's highly or pervasively material, or a qualified report somewhere in between materialities we saw in that chart. We'll see examples on page 65. We'll see then the qualified report, only the opinion section is qualified. Again, the term except will be used, and the auditor's responsibility section is not qualified or changed in any way because an effective audit occurred. And neither is the introductory paragraph nor the management's responsibility section modified. Okay, good. Less for us to remember. And then in the adverse opinion, we'll see the opinion section states the auditor believes the financial statements are not fairly stated in accordance with GAAP. It's really bad. And then number 3, In both reports, a section for the basis of the qualified or adverse opinion is added, and it comes before the opinion section. This way, again, the reader reads down the opinion section. Right before there, the reader knows what's wrong. So with those things in mind, let me go to the book and take a look at figure 310. Qualified opinion report due to non-GAAP, departure from GAAP. This means materiality is in the in-between level. So the independent auditor's report, everything up front's the same, except right at the end of the auditor's responsibility section, we just say that we believe that the audit evidence we've obtained is sufficient and appropriate to provide a basis for our qualified audit opinion. We just insert qualified. Then the basis for the qualified opinion. Well, the company is excluded from property and debt in the accompanying balance sheet. Certain lease obligations that, in our opinion, should be capitalized to conform with accounting principles generally accepted in the United States of America. If these lease obligations were capitalized, property would be increased by $4.2 million, long-term debt by, $4.6 million, long-term debt by $4.2 million, and retained earnings by $400,000 as of December 31st, and then incoming EPS would be increased by $400,000 and $1.75 respectively for the year then ended. Well, I don't know why this client did not make this correction when the auditor first brought it up, because nice things are happening, except for the long-term debt going up, but still, net assets go up by $400,000. Looks like a good thing, but anyway, this is a very stubborn client. It's a very dumb client, may I add. And do you think you want to invest in this client? No. Then the qualified opinion. In our opinion, except for the effects of the matter described in the basis for qualified opinion section, financial statements referred to above present fairly, and the remainder is the same as in the regular audit report. Any questions there? All right, let's skip down to figure 311, adverse. So in this case, this auditor's decided this very same situation is highly or pervasively material. This auditor is very conservative. So again, everything's the same down to that last little paragraph in the auditor's responsibility section. We believe the audit evidence we've obtained is sufficient and appropriate to provide a basis for our adverse audit opinion. Then once again, right before the opinion paragraph, that basis for adverse opinion paragraph appears. Explanatory paragraph, also known as that, same wording. Then the adverse opinion. In our opinion, because the significance of the matter described in the basis for adverse opinion paragraph, the financial statements referred to above do not present fairly. The financial position of Ajax Company as of December 31st, 2016, or the results of its operations and cash flows for the year then ended. So this company's financial statements are really, really bad. I've seen very few of these issued in practice, by the way. I can remember one from over 10 years ago now. It was issued for a payphone company in Tampa. Has anyone used payphone lately? Me neither, no. I mean, there are very few of them these days. Cell phones replace them. So it was not a growing market. Well, this company got an adverse opinion, but the point was moot because guess what happened to the company right after that? They went out of business. Yeah, they were on their way out anyway. Dying industry. But again, with one of these, the SEC will not be pleased. They will stop trading of the company's stock. Well, coming back to the handout in number 4, a qualified opinion is also issued if there is an adequate disclosure. Well, need to have a footnote? I hope the company does, if the auditor says so. Be really dumb if they didn't. Or if all the required financial statements are present. That's an incomplete presentation. Client leaves one off, can't give them a clean opinion. but an adverse opinion is really not applicable to these special departures from GAAP. Could be used in a rare case with an inadequate disclosure if the auditor feels that the public is being misled. And also, if the statement of cash flow is omitted, that's usually the only one that is, because a lot of people don't understand it, the auditor should not mention cash flows in the audit report except to qualify it. Well, then number 5, if the auditor agrees with a departure from GAAP due to special circumstances, may issue a clean opinion under Rule 203 of the EICPA's Code of Professional Conduct, but must add a basis of accounting section after the opinion section. The opinion section would be unqualified, but would reference the basis of accounting used. We will study these toward the end of the class, and if you're curious, you can see where I find that in Chapter 25. But there's a little exception there, that explanatory paragraph or basis section is going to appear after the opinion section, not before, just to let you know. This is very common if we have a client who is on the cash basis or the income tax basis or uses IFRS, International Financial Reporting Standards. So more to come there, but you can have a sneak preview if you'd like. Well, then number 6, remember the auditor gives the client a chance to correct any departures from GAAP before we issue a qualified or adverse opinion. Well, generally, the client gives the auditor the adjusted trial balance. Clients prepare these adjusted trial balances. They may or may not be correct. The account balances on this trial balance are called book values because those are right now in the client's books. The auditor will then gather evidence to determine the appropriate balance for each account, which is the audited value, the correct one. And if there's a difference between the book and audited values, the auditor will propose an audit adjustment to the book value. So this account is overstated by $2,000. We recommend you lower it by $2,000 and try to fix any individual errors too. Well, in B, clients may or may not choose to record the audit adjustments. If they do not record material adjustments, not immaterial but material, then the financials will not be fairly presented in accordance with GAAP, and the auditor will not be able to give a clean opinion. That's how things work. And then, last thing we'll cover tonight is here in E. If the auditor is not independent, heaven forbid, that is really poor quality control. There's a special type of opinion which must be issued. I will show you on page 66. You will not see this in practice, I don't think, because the auditor would not have accepted the client or would withdraw as soon as he or she saw he or she was not independent. It's embarrassing. Remember that materiality is not an issue with independence. Either you're independent or you are not. So let me show you this really short audit report here. Figure 312. Disclaimer due to lack of independence. There is not even a report title. Nothing else but this. We are not independent with respect to HomeDecors.com Inc. and the accompanying balance sheet as of December 31st and the related statements of income, retained earnings, and cash flows for the year ended were not audited by us. Accordingly, we do not express an opinion on them. So again, we see down here, no report title. It's really bad. And the SEC is going to think, wow, this auditor doesn't know what they're doing, so we don't like their work anymore. As an auditor, do we want that feeling from the SEC? No, they don't trust us anymore. So again, I'll record, in fact, later tonight, a short video for you for the remaining sections here of the chapter. Does everybody feel like they've had enough information tonight? I kind of thought that was going to happen. Yeah, a year ago when I covered this in one fell swoop, the same thing happened. A year ago is when I last taught this course at night in one 3-hour block. So the material is easier in that, and this way you can digest that. You've got longer to digest Chapter 3 because I'm giving you an additional week on my accounting lab. I realize there's a lot of information there, but is it pretty much making sense so far? Good. You work with a sum, then you'll really internalize the information. Then you'll be like me someday and you'll know all this stuff by heart. If I took the CPA exam today, at least the auditing section, I think I could do really, really well. Well, I did do well when I took it, but passed the first time, but I would really get a high score these days. Anybody online, do you have any questions? Anything? Please let me know if you do. And like I said, always want you to feel a part of the class, okay? Good. Okay, well, again, let me know if you have anything, and I'll send you the link to the video late tonight. All right, have a good one. See you next week. Whoops, I'm sorry. And 4, there we go online. Okay, I'm just gonna wave goodbye. Can see me now? No, you can't, hang on. Now you can see me, okay, good. All right, take care. Bye-bye, see you next week. Thanks.